Welcome to Breaking News to Trading Moves.
Great to be here.
Today we're looking at the market reaction, specifically the winners and losers, after Levi Strauss gave an update on tariffs.
That's right. Levi Strauss, ticker LEVI, they warned about tariff policies hitting their gross margins. That definitely got the market's attention.
Right, because when a big name like Levi's says something like that, people listen. Our goal here is to quickly see who benefits and who might be feeling the pressure from this kind of policy news.
Exactly. The core event was Levi saying, look, these tariffs are going to be a headwind for us, particularly in Q4.
So let's dig into that. What was the actual news from Levi Strauss, the headline that started this?
The main point was that changing U.S. tariff policies, they're now expected to really hit their gross margins in the fourth quarter.
And it wasn't just a vague warning, right? They put numbers on it.
They did. They talked about an expected Q4 margin headwind of about 130 basis points.
130 points just from tariffs.
Just from tariffs, yeah. And, in apparel, that's a big chunk, especially right before the holidays.
Definitely. And what were the tariff rates they're assuming?
They're planning for 30% on goods from China, and this is key, 20% on stuff from other countries they source from.
Okay, that 20% on non-China sources feels like the bigger worry, maybe, since companies have been trying to move away from China.
That's precisely. Retailers spent years diversifying, and now those other countries are getting hit too. It feels like a broader cost increase across the board.
And the stock reacted pretty sharply pre-market, down around 7–8%, I think.
It did. LEVI shares took a hit.
Now, they did slightly raise their full-year EPS guidance, didn't they, to $1.27 to $1.32.
Yes, but that didn't seem to help much.
Why not? You'd think higher earnings guidance would cushion the blow.
Well, a couple of things. First, the middle of that new range, the midpoint, was still a bit below what analysts were expecting.
Yep.
And second, I think the market sees these tariff costs as a more fundamental problem for margins. It's not just a one-off. That 130 basis point pressure kind of overshadowed the slightly better EPS outlook.
And Levi's is particularly vulnerable because of where they make their clothes, right?
Yeah.
Lots of sourcing in South Asia.
Exactly. Heavy sourcing from places like Bangladesh, Cambodia, Pakistan. That used to be about saving costs, but now it means more exposure to these broader tariffs.
Okay, so that's the trigger. Levi's flags real quantifiable margin pressure from tariffs due to their sourcing. Let's flip this around. Who actually benefits when a major brand faces these kinds of headwinds?
Right. So when costs go up for someone like Levi's, there are opportunities elsewhere. We're seeing analysts point to three main areas. First up, off-price retailers.
Off-price, okay. Like TJX and Ross stores. Tickers TJX and ROST.
Exactly.
Why them? Is it just shoppers looking for cheaper deals?
That's part of it, definitely. If regular prices go up because of tariffs, people hunt for value. But there's another angle, the brands themselves. When tariffs inflate their inventory costs and they need cash, they might divert extra stock, maybe slightly discounted, to the off-price guys.
Ah, so Levi's needs cash flow. So they sell inventory perhaps cheaper than planned to TJ Maxx or Ross.
Precisely. It helps Levi's manage their inventory and cash, and it gives TJX and ROST good merchandise, potentially at a better price. A win-win in a way, driven by the tariff pressure.
Okay, so off-price gets a boost. What's the second category?
Parcel and express logistics. Think FedEx and UPS, tickers FDX and UPS.
Logistics. Why would shipping companies benefit from apparel tariffs? That seems less obvious.
It's about timing and risk. Brands get nervous about potential future tariff hikes or shipping delays, especially before the holidays.
So they ship earlier.
Exactly. They pull forward their inventory. They order and ship holiday goods way ahead of time, often using faster, more expensive air freight or expedited ground services.
Ah, they pay more for shipping now to avoid potentially higher tariffs or delays later.
You got it. And Levi's actually mentioned this. They said they'd already secured about 70% of their holiday inventory early.
70%, just to manage tariff risk. That's a huge early commitment.
It is. That kind of urgent shipping boosts volumes and demand for premium services for FDX and UPS. They're selling speed and certainty when policy is uncertain.
Okay, that makes sense. Off-price logistics. What's the third group?
Supply chain software providers.
Software. Because things are getting more complicated.
Exactly. Rapid policy changes, shifting costs, managing sourcing, figuring out where inventory should go, setting prices. It all gets incredibly complex. Spreadsheets don't cut it anymore.
So companies need better tech tools.
Yes. They invest more in software for things like planning, tracking orders across the whole supply chain. That's order orchestration, and importantly, markdown optimization.
Markdown optimization. How does that help with tariffs specifically?
Well, if your costs just jumped 130 basis points, you need to be really smart about discounts. This software helps figure out the exact right time and depth for a sale to move inventory without just killing your margins completely.
So it helps protect whatever margin is left after the tariff hit.
Precisely. It allows for more surgical discounting.
And companies providing this software, like Manhattan Associates, ticker MANH, or even data platforms like Snowflake, SNOW, they see increased demand.
That's the idea. Retailers need these tools to stay agile and protect profits in this environment. The software investment pays for itself pretty quickly when costs are volatile.
All right, so we've got the potential winners: off-price, logistics, and supply chain software. Now let's look at the other side. Who else, besides Levi's itself, is feeling similar pressure?
Well, the most obvious group is just other global branded apparel companies. Anyone with a similar sourcing setup, especially heavy reliance on Asia.
They face the same math, basically. Higher duties mean higher costs.
Right, and it's tough to pass all of that cost increase onto the consumer, especially heading into the holidays. So their gross margins are likely getting squeezed too.
Any specific names coming up in that context?
Besides LVI, analysts point to Ralph Lauren, ticker RL. Their global model has similar exposure. Also names like Abercrombie & Fitch, ANF, and Tapestry. TPR, they own Coach and Kate Spade. Similar potential margin issues there.
Okay, so broader apparel. What about specific product types? Is anything particularly vulnerable?
Yes. The second group analysts highlight is specialty apparel, especially retailers focused on, say, youth fashion and jeans.
Like Abercrombie again, or American Eagle Outfitters, AEO.
Correct.
Why is that segment more sensitive?
Because it's often very promotion-driven. Lots of sales, discounts are expected. Customers in that segment are pretty price-sensitive.
So if tariffs force prices up,
It's a tough spot. Raise prices too much and demand might drop off. Don't raise prices or use heavy markdowns to keep sales moving, and your margins get crushed by those higher tariff costs.
they don't have much wiggle room on pricing.
Not as much as some other categories, perhaps. It puts companies like ANF and AEO in a bind.
Makes sense. And the final category of potentially vulnerable players.
We need to look downstream at the stores actually selling these clothes. Department stores and mall anchors.
Like Macy's, ticker M, or Kohl's, KSS. How are they impacted?
Their issue is passed through from the brands. If brands like Levi's or Ralph Lauren raise their wholesale prices to the department stores to cover the tariff costs.
Then Macy's and Kohl's have a problem.
Exactly. They have two tough choices. Either they absorb that higher wholesale cost, which hits their own margin.
Which are probably already pretty thin.
Right. Or they pass the higher price on to the shopper. But that risks scaring customers away, hurting traffic and sales, especially during the competitive holiday season.
So they're caught in the middle. Either take a margin hit or risk losing sales.
That's the challenge for M and KSS and similar retailers. Their dependence on these big, import-heavy brands makes them indirectly vulnerable to the tariff impact.
Okay, so summing this up for everyone listening. A policy update on tariffs from a major player like Levi's leads to immediate margin worries for them, and similar apparel companies like RL or ANF.
Right. That's the direct impact.
But that pressure creates openings for others.
Yep.
The off-price retailers like TJX and ROST potentially get better inventory and more value-seeking customers.
Yep.
Logistics companies like FDX and UPS benefit from urgent early shipping as brands try to manage risk.
That pull-forward effect, yes.
And software firms like MANH and SNOW see demand for tools that help manage all this new cost and complexity.
It becomes a necessary investment for survival almost.
While on the flip side, other brands heavily reliant on Asian sourcing, youth-focused apparel retailers, and department stores face margin pressure or difficult pricing decisions.
That covers the main vulnerable spots analysts are watching.
So a final thought for people to consider as they watch this play out.
I think the key thing is understanding that in today's world with these complex global supply chains, policy uncertainty isn't just a line item cost. It forces companies to make really big upfront capital commitments, like Levi's getting 70% of its inventory early just to hedge against risk. That need to spend capital just to manage potential policy changes is becoming a major cost of doing business globally.
Something definitely worth keeping in mind. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.